Thanks for clicking. Canada's economy slowed down to a 3.1% annual growth rate in the first quarter compared to a 6.6% in the final quarter of 2021.
This is not what I wanted at all!
This news comes on the eve of the Bank of Canada's rate announcement set for tomorrow, which is widely expected to include a 50 basis point interest rate hike. A slowing economy is definitely not great news, especially in the face of a 6.8% inflation rate, and is likely to only further stoke fears of stagflation coming to Canada. So what I want to do today is go over the StatsCan report, looking at our GDP data, discuss some of the similarities between now and the 1970s and 1980s that were characterized by stagflation, and then go over what to look for next. Speaking of what to look for next, we're set to have a big rest of the week with the Bank of Canada set to release its policy rate tomorrow, and the local real estate boards starting to release their own data on May's real estate market. We'll obviously have updates on those on this channel. Make sure you click like and subscribe to get those updates, but for now, let's get into this GDP report. As mentioned, Canada's GDP came in at 3.1% during the first quarter of 2022, due in large part to revised January estimates, which showed a 0.2% decline, largely because of the restrictions from the Omicron lockdowns. The report from Stats Canada showed that while household spending is continuing to grow, along with business investment and residential construction growth, we're continuing to see a slowdown of the auto sector, which still hasn't recovered from its pre-pandemic highs. Under normal circumstances, a 3.1% GDP growth rate would be great news, but not with Canada facing a 6.8% inflation rate, and the Bank of Canada is set to raise interest rates by over 100 basis points over the next few months, and maybe even more after that as we move into the fall and winter months. Ideally, we would want to see the economy continuing to grow where it was in 2021, in that 6% range, in order to provide some cushion for the drag on the economy that these interest rate hikes will bring. We've talked about stagflation on this channel before. Stagflation being low growth combined with high inflation. More and more we're starting to hear experts warning that stagflation is coming to North America, with former Bank of Canada Stephen Poloz saying it's coming to Canada, and former Fed Chairman Ben Bernanke warning that it's probably coming to the United States as well. The problem with stagflation is that it's extremely difficult to stop. When you have high inflation but low growth, the only way to stop that high inflation is to raise interest rates, which is going to further slow down growth. If you lower interest rates, you're going to prop growth back up, but your inflation rate is also going to get out of control as well. When you hear about 20% interest rates that happened in the late 70s, early 1980s, the 20% interest rates, those were largely a result of stagflation. High inflation, low growth. So right now, Canada is at 3.1% GDP growth and slowing, and 6.1% inflation and rising, which is really the beginnings of the stagflationary curve. And we're starting to see other parallels with the 1970s as well. The StatsCan report that overall wage growth grew nominally at 3.8% over the previous quarter. And wage growth is great under normal circumstances. We want to see Canadians be able to afford groceries.
It's generous.
However, exceptional wage growth is largely attributed to being a major contributing factor to the inflation rates that we saw in the 1970s and 1980s. As the price of goods went up, so too did demands for higher wages, which also pushed the price of goods up, which led to further demands for higher wages, and on it went. The only thing that was able to break this inflationary cycle was the 15-20% interest rates that we saw in the late 70s, early 1980s. And I don't think very many Canadians want to see 20% interest rates in Canada as of right now.
Speak for yourself.
Fair enough, where you sit is where you stand. But while 20% interest rates did get Canada and the United States out of their stagflationary spiral, not without the cost of a major recession in both countries. So, higher interest rates are obviously coming to a theater near us, and when those interest rates get here, we really want to be starting with a strong economic position. We know when those higher interest rates come, they're going to slow the economy down. That's what their intention is. Their intention is to slow down spending, slow down investment, which will ultimately slow down the inflation rate. However, since we know that a slowdown is coming, it would have been much more comforting to know we were starting in a better economic position at that 5-6% growth rate that we saw last year, and not a 3% GDP growth rate that was just released today. With that said, the Bank of Canada is set to release its interest rate tomorrow, with most economists and most viewers on this YouTube channel predicting a 50 basis point rate hike, which obviously will have an impact on our economy and hopefully will have a big impact on our inflation rate as well. We'll obviously have updates out on that rate announcement on this channel. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.